If you're an investor or a homeowner hoping that interest rates are going to fall anytime soon, you're likely to be disappointed. In this week's Property Insider Chat, Dr. Andrew Wilson and I discuss some factors that have recently occurred overseas and a few local ones that mean interest rates are likely to stay higher for longer here in Australia. We also talk about auction results, investment returns, and a whole lot of things. If you want to keep up to date with what's happening in our housing market, why not subscribe to this YouTube channel so we can inform you each week. In the meantime, why not click the little bell icon so we keep you updated each time a new show comes out. Any property investor would give their second garage to know what's going to happen to interest rates, wouldn't they? While earlier this year, many commentators thought interest rates would fall by the middle of the year, now the narrative is that interest rates will remain higher for longer than we hoped. And even as wars rage and geopolitical climate darkens, the world economy's been irrepressible. It's been a source of cheer for many people. This time last year, most international economists were concerned that high interest rates would bring about a recession. Now even the optimists are being confounded. Just like prior to COVID, most central banks had difficulty raising inflation with low interest rates. Now central banks are having difficulty bringing inflation under control with higher interest rates. So I'm looking forward to my weekly Property Insiders chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of my housing market, to get an update on some of the latest news that gives us a clue to the direction of rates and our economy. Hi, Andrew.
Yeah, good day, Michael. And it has been a big week for, I guess, the view of the direction of interest rates from the market and the so-called experts who really are looking pretty stupid at the moment. We've been saying for some time now that the data just didn't support any prospects of lower interest rates. And finally, of course, the data has consolidated, as we see this time of the year, because we get I guess, the real data over the first couple of months of this year, which we need to wait for some time to come through. And that gives us the real picture on what's happening in the economy. And of course, you know, we've really seen embarrassing turnarounds from the US in terms of its outlook. I don't know why Reserve Bank governors cannot resist the temptation to provide forecasts. It certainly was a significant issue for the former head of our Reserve Bank, who made, and the Reserve Bank in total, who made some really poor forecasts in terms of interest rate outlooks. And I think to some degree, that's why we had a completely new environment now with the Reserve Bank, because of all those mistakes that were made. And we have the same scenario, perhaps even worse, in the US, the US Fed can't resist its need to provide forecasts, which is always a very problematic issue. But you know, the data just hasn't supported any sense of lower interest rates. And the Australian commentators reflecting this on the likely outcome, similarly for Australian rates, as I said, it's almost stupidity, given just how strong our economy is, just how high our inflation rate is, and given the fact that the supply side constraints that are causing higher inflation or keeping inflation high just aren't going anywhere, you know, and I'm talking about housing costs and fuel and electricity costs, you know, but we did have a big week last week where the head of the Fed in the US said, okay, we're not going to get the 4 interest rate cuts that I predicted or we predicted at the end of last year. The market was predicting 6 to 7 cuts. The first was an absolute certainty at the end of last year to occur in February. And now we're seeing that revision, you know, it's a 180-degree turn. We're talking about a 1 to 2, if that, cuts this year towards the end of the year. And we even had the head of the New York Fed, Michael, speculating on possible rate rises, actually mentioned that. So as I said, it's been, I believe, well, from my perspective, a predictable about face. It was just bewildering to hear those predictions of interest rate cuts, given just how strong the US economy is. Of course, our economy is just as strong. The same sort of drivers are continuing to put upward pressure on inflation, strong labour market, high retail sales. Building approvals are falling sharply in the US, so no supply side relief for higher rents. And of course, oil prices have been significantly higher over the past few months. So I'm not sure, you know, whether it was the irresistible urge to provide good news But whatever it was, we've had a big turnaround. And of course, I think a lot of those Australian commentators who were bewilderingly predicting cuts to interest rates in this country will, of course, revise their interest rates. But gee whiz, Michael, we should be used to that by now.
Back home, Andrew, the labour market's been very strong despite our higher rates.
Well, of course, Michael, this is again, the story with interest rates. We're really not going to see a significant downward shift in interest rates until we reduce demand. And well, any shift in interest rates until we reduce demand. And the key signal for reducing demand is higher unemployment. And I'm talking, a 4, or probably more realistic, a 5% unemployment rate until we get, which is what we need to get consumers paring back on their spending patterns. Now, we had the latest unemployment rate released last week for February, a little higher than the previous month, but at 3.8%. These are very, very low, historically low levels of unemployment. We have to go back to the early 70s, which was a completely different economy in Australia, single income households, etc., to see these sorts of numbers. And we've just had a continuous, really, except for the 2 months ago, a 3% something unemployment rate. Now, the actual numbers are drifting around. We know that the ABSs have problems with their seasonal adjustment models following a 116,000 increase in jobs over January. Jobs fell by 7,000, so still over 100,000 net over 2 months. Unemployed were higher by 7,000, but that followed a 52,000 fall the previous month. So again, lower unemployment by over 40,000 over the 2-month period. Participation rate down slightly, but still near record lows. And when we look at the comparisons in New Zealand and the US, they've got the same sort of very low numbers, 3.8% in the US, and New Zealand has 4%. And of course, New Zealand's in a recession. So these numbers just really beg a belief for the commentary that's been provided on lower interest rates this year or soon. And it's really just a question of, wishing and a hoping and a praying. And also, what I am concerned about is there's vested interests that are trying to talk interest rates down, because that will likely mean, changes in the bond rate, which will encourage investors one way or the other in that market, and also changes in our equity markets, in the stock market.
Well, if we look at the unemployment figures, they vary from state to state, don't they?
Well, they do, but and they're all higher than where they were a year ago. We know we're not as strong as we were a year ago, but the Reserve Bank tells us we're still at fuller than full economy, if you know what I mean. We still have a stronger than full a full labour market economy. So we've still got way too much demand for supply of jobs in our economy. And even though we've come down a little bit from, or come up a little bit from where we were a year ago, we're still in those threes, and Western Australia is the strongest state, just above or just below New South Wales in terms of those state results. But certainly we're talking about full employment economies here.
Well, Andrew, you also spent some time at My Housing Market looking at investment returns, how it's working for property investors, and also, interestingly, how it compares with investing in the share market. What were your findings?
Well, we've had our recent housing market report, house price report, and rent report, Michael. So if we put those together and look at what yields are doing, these are gross yields. And of course, the gross yield calculates what the annual return using the current median rent on each of the capital cities is on the current median asking price. So these are gross yields, of course. They don't take into consideration, other costs for investors, and of course, their rates and interest rates and other bits and pieces, insurances. So these are just overall gross investment costs. And when you look at houses, Perth is leading the charge there. Of course, we know Perth's been had a very strong growth rate for house prices over the last year, strongest of all the capitals. We also know Perth, along with all the other capitals, is also seeing a surge in house rents. We put that together, and Perth is at the top end of the range for house gross yields, just a tick over 4% followed by Brisbane 3.5%, Adelaide also 3.5%, Melbourne down at 2.9%, and Sydney at 2.51%. Of course, that reflects the higher prices in Sydney, and of course, you know, rents in those smaller capitals, the difference between rents and prices is closer in the smaller capitals than it is between the bigger capitals such as Melbourne and Sydney. But the interesting thing in terms of gross yields, Michael, at the moment is when we do see higher yields in a market compared to what we would consider to be the overall yield, it can tend to show that that the capital value of the property is probably a little bit undervalued, and therefore we can see that that would generate interest in those higher yields, which would mean the capital asset would grow, and that would mean the yields would fall. And that's sort of part of that consolidation period between yields that we can see from investments. But in this particular market, we're unlikely to see that consolidation, because even though there's increased demand for a particular asset, there's also increased rental income. So we're getting capital growth, and we're also getting rental growth, which is keeping those yields in those smaller markets, which have higher yields, at those higher levels. So an interesting time with higher growth rates and higher rents, higher prices and higher rents, continuing to sort of consolidate those higher yields. Same situation when we look at gross investment yields for units. Perth, of course, as a smaller unit market, prices tend to be volatile, but still, nonetheless, those Perth yields are very attractive at 7% for units. Brisbane, of course, though, has a more significant unit market. Its gross yields currently at over 6%. Again, those sort of higher numbers relative to other capitals tend to point to the prospect of lower yields on the back of attracting those higher yields, attracting more demand for the asset, which of course puts the asset price up, and that pushes the yield down with a specific rent. But as I said, rents are increasing as fast as prices at the moment, so that's keeping those yields quite high. And again, the higher yields in units that we see compared to rents, again, is that part of that differential, that the difference between prices and rents in units is much closer together than it is compared to houses. So some good returns there. But I think the main theme, Michael, is that we're seeing those rents actually stabilise, because those yields stabilise because we're seeing rents and prices rising at the same rate at the moment. And of course, it's not just about gross yields, return on investment from rentals that are important to investors. Of course, it's capital growth as well. So if we put capital growth over the past year with the current data, with those gross yields, we can see those spectacular returns. Again, Perth, of course, the top performer, 26% total returns for Perth. That's gross yields and capital growth for houses. And Brisbane, 21%, Adelaide similar, 20%, Sydney and Melbourne lower. They haven't had the same, Melbourne particularly hasn't had the same growth rates as those smaller capitals had. And the same story there with unit total returns, capital growth and gross yields, with Perth leading the charge. And again, Brisbane just below Perth. Really attractive results there for that big unit market in Brisbane. So that's, I would suggest, pretty reasonable returns for investors, Michael, with the current data. And as I said, I think the scenario is that we're continuing to see price growth, and we're continuing to see rental growth as well. So in a sense, it's the best of both worlds. And what we've done also is compare these returns with the returns we're getting on the share market. Perhaps a little bit cheeky to do that. This, of course, these comparisons do relate to, in a significant way, where you set your benchmarks. Now, we've set our benchmarks here, our starting point, to compare the share market and house prices at the end of 2007. That was at the peak of that big mining boom that we had. We had very strong prices growth. We had a record share market. So use that as a starting point since the peak of that 2007 mining boom. I think that's quite a logical starting point. And you can see just how things have changed over the 17 years since then. Sydney house prices up by 170%. The All Ords, which measures the Australian growth in the Australian housing share market, up by 14.2%. And the other capitals have also recorded significant growth compared to the share market. And it's not just about shares, because when we look at the US share market as measured by the Dow Jones Index, we can see that's actually improved even better than the house price growth has over that period, but certainly significantly higher than Australian shares. And I guess that must be sobering news to some degree, Michael, to those who have superannuation accounts, which do reflect what's happening in the share market. So perhaps a little cheeky there, but nonetheless, I think it's just shows again the the benefits of housing investment. And I know there are plenty of offsets for share market investment in terms of tax advantages, etc. But we also have that for housing as well.
Yeah, they've got the franked dividends, but the share market's much more volatile, Andrew.
Right.
And there's also the great ability to leverage property. So return on your funds is more important in some ways than total returns. But clearly the US share market's outperformed the Australian market. I guess it's all those IT stocks, Google and Meta, and
and I
those
think
ones that are
the
doing
salient
well.
point whenever I have this discussion with advocates is that you can go out and get yourself an 80% valuation loan on a house. Just try and do that on a share portfolio, from a bank. Not sure you'd be very successful doing that.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with my team at Metropole to discuss your goals, your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. At Metropole, we're big enough to tip the scales in your favour, but still small enough to care. And since we don't sell any properties, our advice is independent and unbiased. Now, remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, again, we always discuss the auction results because it gives us a good indication of how buyers and sellers are feeling on the ground. April's a disrupted month with school holidays, Easter, Anzac Day coming up this week too. How did the auction markets perform over the weekend, Andrew?
Well, yeah, you're right, Michael. Of course, that we're in the middle of the school holiday period. Some are just beginning, some are in the middle, some are just completing it. And April is a holiday month, as you said, Anzac Day coming up. So there'll be another long weekend taken by many, even though it's a Thursday. So we see typically lower listing numbers as the holiday period comes because, people are on leave. And we also see that the proportion of properties under the hammer changes. We see a lot fewer as a proportion higher and middle price properties compared to lower price properties. But the markets have stood up. Firstly, clearance rates have stood up really well through the holiday period. Sydney was down. It started the school holidays last week. Sydney down to its lowest result in some time. But as I said, this is a holiday period. But I think what's interesting and of course, listings were down. But I think what's interesting is, again, we look at what happened a year ago in the same period, that listings are significantly higher this year compared to the same period last year. And you can see that with Sydney well ahead of its school holiday listings compared to the same period last year. Clearance rates are lower. Of course, we as we've mentioned, Michael, we moved into a very strong period in our auction markets in the autumn season last year through to winter. That was the catch-up market. A lot of pent-up demand was starting to be released as confidence grew. Given that we had a weaker market in 2022. So we're unlikely to see those very high clearance rates through autumn and winter this year, but nonetheless, they still remain in favour of sellers and prices are still rising. So Sydney, auction numbers down, but still well ahead of a year ago. Clearance rates down, still a seller's market per se with that 66.6% result. Melbourne holiday market, just coming to the end, 800 listings there, which is similar to the weekend before, but the clearance rate was actually higher in Melbourne, which is a positive sign. And again, listing numbers were well ahead of a year ago. But as I mentioned, the clearance rate was lower compared to that very strong period last year. Big numbers back into the Brisbane market. Its clearance rate was also higher on resumption there, and its clearance rate's well ahead of a year ago. Adelaide a little lower, but still a strong sellers market in Adelaide with big numbers of auctions. And the Canberra market, which we've discussed, is showing some real signs of revival after quite a subdued year last year. And it was an outlier in terms of its performance in the auction markets compared to the other capitals, but certainly showing some improvement. Canberra, although listing numbers were quite low. And as we sort of have mentioned a couple of times, Michael, that with those higher listings, we're also seeing higher numbers of actual auction sales. So we've actually seen a record number of properties sold under the hammer over the period to date compared to the same period last year. In fact, Sydney auction sales are up by nearly 40%, Melbourne up by nearly 20%, Brisbane up 26%, Adelaide up 4%, and Canberra still struggling down compared to last year, down by 4%. But as I said, the signs are improving, particularly for clearance rates in Canberra. So good news there for estate agents, Michael, who will be enjoying those higher commission, those higher prices. Well, so, higher actual numbers of sales and higher prices. And of course, good news for state governments with stamp duty. Those that have the stamp duty, there's one or two perhaps that have got rid of that. And it's interesting that those markets that don't have stamp duty are sort of underperforming the ones that have land tax. And of course, I'm mentioning Canberra there. And we know Canberra had a pretty quiet year last year. Is it because of those land taxes? I don't know. Maybe it is. But
well, the thought behind that, of course, Andrew, is that stamp duty is one of the deterrents to move house, especially for downsizers. So the Canberra government has removed stamp duty and everyone pays land tax now, but it actually hasn't helped push the market up. You'd think it would have done the opposite.
That's right. And I'm not sure Canberra voters will be happy seeing their underperformance in terms of capital growth and the value of their properties compared to other capitals that still have the stamp duty model, So even though it's a convoluted model out of Canberra, it's not doing very well in terms of, it might be good maybe for first home buyers because they're seeing lower prices. Yeah. But they have to pay stamp duty every year by and large. But it's not good for those non-first home buyers that aren't seeing the capital growth that they would like to do and all those tax-free returns that they continue to get on capital growth, not anywhere near what they're seeing in Sydney, Brisbane, Adelaide, and Perth.
Well, one other point about the surge in auction sales is I think it's showing the depth of confidence in the seller market, because sellers are prepared to put their properties up for auction, expose themselves to the public, have everything out there to see what's going on. But they've been paid back with good results, Andrew.
Yeah, that's right, Michael. And it sort of puts paid to some of the, very ordinary analysis that we had last year was, we had stronger clearance rates because there were low listing numbers, right? Which was compared to the previous period where there was long, which was the shakeout from COVID. But this year we've got record listing numbers and still high clearance rates. So not sure how that works with those theorists, and that's in inverted commas. Well, they are theorists who have said that the auction market reflects supply and demand more than other things, because we know most buyers are sellers and sellers are buyers. So that puts that supply-demand argument out the window. But we know Australia is characterised by a lot of, self-appointed experts that come and go. And it's just important that you not take decisions based on some of these positions, in terms of particularly the auction market and the broader housing market. But look, it's been an interesting week. It's not good news, I guess, for those that were hoping they'd get an interest rate cut this year. But you can't speculate on something that's just, as I said, wishing and a hoping and a praying. The reality is that, we still have a long way to go before we've controlled inflation. But the other reality is our house prices are growing still, and have had a very good last 12 months. And investors will be very happy with the increase in rents and the very tight rental market that we have at the moment.
Well, thanks for giving us that information. Look forward to catching up with you again next week, Andrew.
Yes, thanks, Michael.